But our next guest says to take the milestone with a grain of salt. UBS head of credit strategy, Matt Mish, joins us now. How severe are these delinquencies?
Well, I think, certainly you've seen two things that I think are notable. One is we're not just talking about subprime ABS delinquencies anymore that are near elevated levels. We're talking about prime, right? And about 80 to 85% of all auto loans or financing for an auto purchase essentially are prime. The second thing I would say is that, again, these levels have been certainly elevated relative to the last, call it 3 to 5 years. But what we've really seen is a notable uptick. And again, you are approaching 2009 levels. Now, having said that, we do think that investors should take this with a grain of salt, particularly in terms of the read for the overall consumer health. And there's a few reasons for that. One is that net losses are not keeping up at the same rate as the delinquency surge that you're seeing. And a lot of this, we believe, is due to something called churning. That's when consumers miss a payment or two on an auto loan and then start to repay. And so there's some underlying fragility, but ultimately consumers want to keep the car and are basically making payments after missing a few. The second I would just say is that non-revolving credit growth remains fairly strong. Through July, it ticked up a couple of percentage points to about 5% year on year. And revolving credit growth as well is also fairly stable. And the last point really is that overall, we believe that auto loans account for about 9% of household debt, 4% of bank loans in the U.S. And so, this is an area where obviously, crises don't strike twice, so to speak. Housing is not going to be the problem. The areas that are of concern are really consumer loans within household credit, and autos is certainly, as well as credit cards, in focus right now.
And those aren't as bad? Is that what you're saying in terms of delinquencies, defaults?
Those are not. I mean, mortgage delinquencies are increasing, but still about a standard deviation below average. And keep in mind that mortgage credit is about 70% of total household debt. And so, from our side, what we did was downgrade our view for high grade and high yield auto credit to underweight. But we didn't necessarily change the overall softish landing that we have on the consumer. Because I think it's too early. There's enough data points that suggest this is not necessarily, as you say, a canary in the coal mine that investors should seize upon.
Still, it's a risk. And I do wonder, Matt, if you see it priced into the financials at this point. I remember that Ally warning a few weeks ago at the Barclays Financial Conference of credit challenges, especially tied to autos, is in the banks.
Yes, I think, from our standpoint, we downgraded the high yield financial sector to neutral. I think you have to separate banks from the rest of the financial sector. But I do think that there'll be some challenges going into third quarter earnings. We've seen that with some other cyclical names like KB Home overnight. And so, I do think that if this is a credit cycle as it normally plays out, where those areas that are more vulnerable start to deteriorate first, certainly higher beta or lower quality credit or names in the stock market. In those areas that people are looking for more pressure, again, within household debt, we would say it's not going to be mortgage credit this time. It's really going to be consumer credit. These are areas that you would expect, and I think we will see some pressure as we go through the next few months, particularly given while the Fed is cutting, interest rates are still restrictive.